Alright, welcome back to another video. I'm Lance Bergs from YourTradingCoach.com. Today we're going to take a quick look at the hammer. The hammer is a bullish reversal pattern. It consists of only one candle as displayed in the video here. It's an easy one to remember because with a little bit of imagination it looks like a hammer. Okay, perhaps a fair bit of imagination. Now if you watch the video on the hanging man pattern, you may recognise the fact that both the hanging man and the hammer look the same. There are of course some differences, otherwise there'd be no need for this video. Essentially the hanging man is a bearish reversal pattern occurring at the top of an uptrend. The hammer looks the same, but it's a bullish reversal pattern occurring at the bottom of a downtrend. How easy is this stuff? Okay, like the shooting star and the hanging man, the real body of a hammer can be either colour, red or green. The green body is slightly more bullish than the red body, and I'll demonstrate that shortly when we discuss the psychology or sentiment of the pattern. The lower shadow is at least 2 times the size of the real body, and ideally there's no shadow above the candle. However, a very small shadow can be acceptable. As I mentioned at the start of the video, the setup leading into a hammer reversal pattern must be a downtrend. If you don't have a downtrend, then it's not a valid pattern. Sideways trends don't count. If it's an uptrend, then it's a hanging man, not a hammer. So the hammer occurs at the bottom of a downtrend. And ideally, if we're sticking again with strict textbook definitions, we'll see a gap down from the close of the preceding candle to the open of the hammer. Of course, that won't apply for continuous markets such as Forex. Confirmation of the trade will be price trading above the candlestick pattern, so above the highs in this point here. The level of confirmation required will vary depending on the trader's risk profile. Aggressive traders may enter as soon as price moves above the high of the hammer. More conservative traders may wait for a close above the high. Others may wait for a complete real body or even candle above the high of the hammer. As always, use whatever works for you in your back testing. So which of these are hammers and which aren't? Well, all exist at the bottom of a downtrend. All have a lower shadow greater than 2 times the size of the real body, with confirmation of price trading above the high of the hammer. So all of them are valid hammers. Let's look at the psychology of the pattern now to see who is in control, the bulls or the bears. The downtrend initially appears to continue strongly with price gapping down at the open and then continuing to new lows. At this stage everything is looking bearish. Your buy and hold friends are in a world of pain. However, leading into the close, the bulls are able to show some surprising strength and drive price upwards to close in the top third of the candle. Has the bullish move been sufficient to destroy the confidence of the bears, allowing the bulls to now regain control and drive prices higher? To answer that question, we need to see confirmation through price trading above the high of the hammer here. Confirmation will alert us to a potential change of sentiment. The bears were obviously shaken. Their attempt to keep prices lower was not sustainable, and the bulls have regained the upper hand. Depending on your trading plan, this may be an opportunity to exit if you've been trading the downwards trend leading up to the hammer here, or an opportunity to enter long and trade the change of trend here. So which pattern is more bullish, the red hammer or the green hammer? You should be getting fairly good at this by now if you've been through the other videos. Let's look at the nature of price movement within each candle. Both candles ideally gap down at the open and move price to new lows. In both cases, the bulls then come back in force and drive the price back higher. However, the red candle closes at the base of the real body here, while the green candle closes higher at the top of the real body. So you can see in the example in the video that the bulls were able to drive the price higher in the green body, closing nearer to the high in the green candle than in the red candle. So while both a red and green hammer are bullish reversal patterns, the pattern is considered slightly more bullish if it's green than if it's red. Let's look at 2 examples. First, the daily chart of Valero Energy. A downtrend leading to lows, a strong rally which actually just took out the highs of the small congestion area here to the left. So the bulls have shown some strength, followed by a retest of the lows. And what do we find there? A hammer pattern. The small shadow above the candle is acceptable. A price above the candle shows confirmation we need to validate the pattern and signal a potential change of trend. And check out this example, a daily chart of Juniper Networks. I've chosen something a little different here. We've got an uptrend this time, a gap, followed by retest, and then continuation. The bears then forced a solid retracement that takes price right down into the area of strong support, right down towards the recent gap. Once again though, price cannot close the gap. A line has been drawn in the sand and the bears cannot take it lower. A hammer, and then confirmation of price above the hammer, shows the bulls are clearly the dominant force and offers a low risk entry for a great trade in the long direction. After explaining that a hammer requires a downtrend, is this a valid example? Absolutely, it's a great signal. Alright, let me explain. When I say it needs to be a downtrend, this is not valid. It's clearly an uptrend, and the candle at the top is a potential hanging man, confirmed as a hanging man if price trades below the low. This is not a hammer as well. The sideways trend here shows no dominant force amongst the bulls or bears until one side breaks out of the narrow range channel. And this baby here obviously is a potential hammer at the bottom of a downtrend, no doubt at all. We just await confirmation now through price trading above the highs. But this is also a hammer, an uptrend with a good retracement, such as we saw in the previous Juniper Networks example. Not sideways movement, not an uptrend, but rather a nice downward retracement is sufficient downwards movement to validate the hammer on continuation of the price move in the upwards direction. Well, once again, that's it folks. Coming up in the next video, we'll continue with the single candle reversal patterns, looking at the inverted hammer. You might be able to guess what that is right now. In the meantime though, open up your charting package with your favourite stock, index, commodity or currency chart and see if you can find any hammers at the bottom of a downtrend, or a nice retracement within an uptrend as I showed before, leading to either a halting of that trend or a complete reversal. I'm Lance Beggs from YourTradingCoach.com, wishing you happy candlestick trading and many profitable hammer reversal patterns.